Hi, welcome again. Let's look at the next bit of this capital or chargeable gains tax. So we're looking at the situation of exempt items or chattels and part disposal. Okay, so we typically looked at the initial scenario where we index or we understand the indexation, and in terms of representing these calculations in a suitable format to claim. Okay, now let's look at what these chattels and those exemptions and the rules that apply to them. Now, for chattels, we split them into two. We have the non-wasting, and then we have the wasting. Now, typically, the non-wasting chattels deal with the tangible, movable assets. Okay, examples like antiques and then paintings. Now, once the disposal of a chattel is for 6,000 or less, it is typically exempt from chargeable gains. There will be no chargeable gain arising from that. Now, a special rule applies if the chattel is disposed of for 6,000 or less, but then the cost was more than 6,000. In that case, we'll equate the proceeds to be 6,000. So just take note of that. If we sold it for 6,000 or less, let's say for 3,000, 2,000, but then the cost exceeds 6,000, we just equate the proceeds, okay, the sales value to 6,000. Typically, we know that a loss will result because if we bought it for 10,000, for example, and we dispose it for even 6,000 or 5,000, a typical loss will apply over there. Okay, let's proceed and see how to deal with these situations. Now, non-wasting chattels, like we said, again, if the disposal proceeds exceed 6,000, then we have to apply this 5/3 restriction rule, okay? Or yes, the 5/3 restriction rule. Now, the chargeable gain should not exceed 5/3 of the amount by which the disposal proceeds exceed 6,000. So, assuming we sold it for 10,000, and then the disposal proceeds, whatever amount it is, there's a rule where we have to subtract that 10,000. We have to subtract the 6,000 threshold from the 10,000 and multiply it by 5/3. Whatever we get, we compare it to whatever gain we have computed, and then we choose the lowest. Remember, in all cases, if there are gains, we choose the smallest. Okay. Now, typically, this 5/3 rule applies, or restriction applies to antiques and then paintings. Okay. So, in a nutshell, in terms of the special rules for non-wasting chattels, if the proceeds or the amount we sell, the amount we get from the sales is 6,000 or less, but then the cost of the item is also 6,000 or less, typically it's exempt from CGTs, okay? But if the proceeds is 6,000 or less, but the cost is more than 6,000, we will typically make a loss, but then we deem the proceeds to be 6,000, okay? Now, what if the proceeds exceed 6,000, but regardless of the cost? Then we undertake a normal calculation and compare it with the 5/3 restriction, okay? We'll look at examples and we'll understand this better. So, J Limited sold the following assets in December 2018. One, Antique Table had a cost of 3,000 in February and sold for 5,000. Both cost and disposal are less than 6,000. So typically this is exempt, okay? Antique painting had a cost of 2,000, sold for 10,000. So cost is less than 6,000, and we sold it for 10,000. What will happen? Okay, you see the typical gain there. All right, we'll work it and we'll understand. Now, an antique vase had a cost of 8,000 in 2003 and sold for 3,000. So cost is higher than the value that we sell. So this is where we have to deem the proceeds to be still 6,000. And a vintage car, which had a cost of 7,000 in July, sold for 9,000. Remember in the earlier slide or in the earlier video, we mentioned that cars, motor cars, vintage cars are exempt. So typically the D will also be 0. Okay, so the main area we have to focus concentration or calculation on is the B and then the C. A, because both cost and proceeds is less than 6,000, that will be exempt. So that will be 0. All right. Now we've been given the RPIs for the various dates, and then we're asked to calculate the net chargeable gains or losses arising. So we find the answers for all A, B, C, and D. Like I said, A and D will typically be 0. So we'll find B and C, and then we add all. Okay. So number 1, like I said, cost is 3,000. Disposal proceeds 5,000. Both costs and sales are less than 6,000. So exempt 0. Okay. And it's an unticked table. Yes. B. So for B, this is also a non-wasting chattel. Cost was 2,000, sold for 10,000. Then we compare to the 5-3 rule. Okay. So let's go and do our calculation. Disposal proceeds 10,000. Any qualifying assets, any charges to disposal or cost to disposal, there's none. So we subtract our cost of the assets. Okay. And we get 8,000 on indexed gain. We find the indexation as usual. We know the formula. Okay. The figures have been given. So against the cost, okay, against the cost, there are no other allowable expenditures. So just for the cost. 652 subtracted from the unindexed gain, and we get 7,348. But then we do the 5-3 rule. Okay, so for the 5-3 rule, it's 10,000 proceeds minus the 6,000 threshold, okay, times the 5/3, okay, which gives us 6667. We initially had a gain of 73.48, and now we have 66.67. We take the lowest. So here we are going to report only 6667. Great. Question number 3. So we look at, again, a vase, antique vase, which is a non-wasting chattel, okay. Cost was 3,000. Proceeds, cost was 8,000. Proceeds was 3,000. Typically, we make a loss, a capital loss of 5,000, right? Now, but then in this scenario, we have to equate the proceeds to 6,000. So cost was more than 6,000, sold for less than 6,000. So our deemed proceeds will still be 6,000 per the schedule. Remember the rule, okay? So the deemed proceeds is 6,000, and then the cost is 8,000. We make a capital loss of 2,000. Typically, in real time, we know that the cost, the loss we have made is 5,000, which is 8,000 minus 3. But the capital loss we can only claim will be 2,000. Okay. So we claim 2,000, not 5,000. We are restricted to 2,000. Okay. And then D, like I said, vintage car is exempt. So let's summarize our findings. So asset A is nil. B is 6667. We took the lower of the two gains. And C, though we made 5,000 loss, we are restricted to only 2,000. Now, D is nil. So the net effect or the net chargeable gain will be 46.67, taking out the 2,000 loss from the gain of 6667. So this is what we charge to our corporate accounts, for which reason we don't have to pay our corporation tax on. All right. Easy. This quite easy. All right. Perfect. Easy. Now, wasting chattels. So if you look at non-wasting chattels, so for wasting chattels, we are looking at those chattels which have predictable useful life of 50 years or less, okay? These are exempt from chargeable gains regardless of how much they are sold for. So examples could be race horses and greyhounds, okay? Now, there's an exception, okay? So except for movable plant and machinery, these are eligible for capital allowances, and they are treated as non-wasting chattels, okay? Now, movable plants and machinery, which are typically eligible for capital allowances, are not exempt from chargeable gains, okay? They are not exempt. So one of two situations could arise, and the most common situation is where we are selling this item for less than the cost, okay? We are selling it for less than the cost. In that case, what happens? You know, the capital allowances will be given as the same as the loss we have incurred. If we sold it for less than the cost, the loss which will arise is what we'll claim as the capital allowances. So in effect, there's no capital loss, okay? Because you are claiming capital allowances for the loss you've incurred. The second situation occurs where we are selling it for more than the cost. In that case, we know capital allowances will be 0 as the cost is removed from capital allowances calculation. So here, the gain calculated will be as the normal gain we've always known, okay, in our capital allowance computation. Yeah. Now, let's look for reliefs. There are two reliefs that occur under chargeable gains. We have the rollover, where we, as the name sounds, we roll over or we defer this gain, which we have realized on the disposal of a business asset, which is replaced. Okay, typically it covers land and buildings, and it is not taxed until a replacement asset or until the replacement asset is sold or never replaced. Okay. And then we have the handover relief. Here again, we temporarily hold off the gain for a maximum of 10 years if the replacement asset is a depreciable one. Okay. And usually it covers fixed property, plant, and equipment. Okay. Fixed plant and machinery. Let me put it that way. Fixed plant and machinery. Great. Now, again, on the rollover relief. So normally there are some criteria we need to identify. So any relief under these provisions will give us, will enable a gain which we have realized on the disposal of the asset to be rolled over. Okay. How? By deducting it from the cost of a replacement asset. Now there's criteria which we need to identify. We need to note out. So first, both the old asset and the replacement asset must fall into one of the following categories: land and buildings, okay, or other qualifying assets, or into fixed property, plant, and equipment, depreciable assets, okay. Now, these new assets acquired should be 12 months before or up to 36 months after the disposal, okay, after the disposal of the old one, okay. Again, these assets must be used continuously in the business, in the operations of the organization, and rollover relief will be reduced if some of the sales proceeds are not reinvested. We'll take a typical example to analyze all of this. So any rollover relief will be reduced if an extra proceeds were not reinvested. Okay, so we got let's say we had a proceed of 200,000 and we have replaced or reinvested 150. The remaining 50 that we have not replaced, what do we do with it? Okay, so any rollover relief we get will be reduced by this extra which we've not reinvested. So once again, when we are replacing these assets with a depreciating asset like property and equipment, plant and machinery, okay, this asset is normally expected to have a useful life of 60 years or less. In this scenario, the gain is not deducted from the cost of the replacement asset, but it is frozen. Okay, so the gain will not be deducted, it will be frozen until one of these three scenarios occur at the earliest. So until either the depreciable asset is sold, or it ceases to be used, or after 10 years of expiration from the date of replacement. So the earliest of these dates is what we have to consider. The date the depreciable asset is sold, or the date the depreciable asset ceases to be used in the business, or the expiration of 10 years from the date of the replacement. Let's take an example, a typical one. So M Limited sold a freehold office property, office buildings for $350. Legal costs associated with the sale was $10,000, but they had purchased this office building in 1992 for $148,000. They sold it in 2015. The RPIs have been given for 2015 May when they sold it, and July 1992 when they bought it. Required. Assuming M Limited purchased a replacement freehold office building on 1st June 2015 for $300,000 and claims to roll over any gains arising. Calculate the rollover relief, the replacement cost of the new building, and the gain immediately chargeable. Now, explain how the rollover claim would have changed if on 1st June 2015 it had acquired instead a fixed plant and machinery for $340,000 rather than purchasing the freehold building for $300,000. Let's do the analysis. Okay. So for item number A, what do we have? So disposal value on May 2015 was $350. The legal costs we incurred during the sale was 10,000. So we get to 340, right? Any allowable expenditure, the cost of the assets, we bought it in 1992 was 148,000. Any other incidental costs to buy, any enhancements? No, nothing. So we get a net on index gain of 192,000. We deal with our indexation allowance, easy to calculate, right? So we get against the cost, okay, of 148,000. And then we get 127 as indexation allowance. Subtract it from the 192, and we gain the net charge, okay, chargeable gain of 64,424. That's the chargeable gain. All right. Typically, this is what will work, okay? Now, if we proceed, the net proceeds was what, 340? We replaced it instantly with a new building of 300,000, which means we've not reinvested 40,000. Okay. Now, tax immediately the lower of what? The 40,000, the amount kept, okay, or the actual gain. So we need to tax immediately the amount, the lower of this. So compare the gain we had was 64,424. Subtract the amount we have not reinvested, 40, the gain left in charge, and then what we get is 24,424. So this is what we roll over. Okay, this is what we roll over. So you've not reinvested the portion, knock it off from the gain, and whatever you get is what we roll over. Okay. Now, typically the HMRC by concession will allow the net proceeds to be used in this analysis. Okay, that's why we are asterisk the first item over there. Now, if we look at the cost of replacement, the cost to buy the new house or the new building was 300,000, right? What about the amount we rolled over? So we have to reduce this amount from the 300,000 to what? 24,424. So the revised base cost will now become 275,576. Okay. Now, in any subsequent sale of this new office building, the cost we have to use for any computation and on chargeable gains, okay, will not be the 300,000, but it will be the 275,576, because you have to always reduce the cost, okay, of the replacement asset by the rollover amount, rollover gain. Okay, we have to reduce it. All right. Now, part B says that we bought fixed plant and machinery for the same amount of 340,000, right? So what do we find over here? All the amount which we gained had been reinvested. So since all amount reinvested, the whole gain is subject to relief. Okay, so the new assets, plant and machinery, is a depreciable one. We are looking at where it has a predictable useful life of 60 years or less. So therefore, the gain will be deferred instead of being rolled over into the base cost of the replacement asset. We cannot knock off the gain of the 24,424 from this. So we have to defer it instead of, because all the proceeds had been reinvested, we have to defer the gain instead of being rolled over into the base cost of the replacement asset. We don't do that. Okay. So how do we recognize the timing, okay, and measure this, okay? The gain will come back into the charge at the earliest of when this property, plant and equipment, the fixed machinery, okay, when this plant and machinery, let me be sure of the word. So fixed plant and machinery, yes. So we have to recognize this gain. It will come back into the charge when the fixed plant and machinery ceases to be used in the business, or the earliest of the date when the date on which it ceased to be owned by the company, or we sell it, or 10 years after the acquisition. So the earliest of this is when what will trigger the gain to come back into the charge. All right. Now, part disposal. Sometimes you want to dispose parts of an asset. Okay. So what happens? So if only parts of the chargeable asset is disposed, then any costs associated with the part together with any revenue or inflow associated with the part disposal is what we have to consider. Okay, so that's what we have to consider. Now, the allowable part cost will be considered the full cost of the original item. So if there is a whole land that we've purchased for 25,000, the allowable part cost will be the 25,000 times this formula, okay, times this formula to get the part cost. So the formula is simply the disposal value divided by disposal value plus the value part remaining. Okay, so an example, we have a land which was 6 acres plot of land. We bought it at a cost of 25,000 in April 2009. In December 2018, we sold it. We sold 2 acres of that land for 50,000. All right, because we thought it was surplus to requirements. Now, the value of the acres remaining after the sale is estimated to be 100,000. Okay, so we sold 2 out of 6, and we still think the remaining value of the 4 is 100,000. Calculate the chargeable gain on the sale of the 2 acres, and we have our indexation. The RPI is given for disposal date and acquisition dates. Okay. Now, as usual, we sold it for 50,000. Okay. The part cost which must be allowed is the disposal value divided by disposal plus remaining parts times the original cost. Okay, so we will assume that the part cost will now become 8333. This becomes our on-index gain. There are no other allowable expenditure. We do our indexation, which we can easily now calculate. I believe we understand now. So against the cost of 8333, that gives us 2625 subtracted from the on-index gain of 41,000. And what we get is a gain of 39,042. So this is what we will then have to post into our account for corporate tax purposes. Quite easy. Very, very easy. Okay. Very easy. Great. So based on this, I think we should all be good to go in terms of working out chargeable gains, both for the exempt items and also for the qualifying assets, and also using the formula to work this out. Great. Thank you.